Let me tell you something brutal, something most traders will never admit. You are trading in a world built on rules you've never even read. And that is why the market crushes you. Before you scroll charts, before you chase setups, before you drown in indicators you don't even trust. There was a time when one man, alone with nothing but ticker tape and a ruthless mind, decoded the market's behavior from scratch. His name was Charles Dow, and the laws he discovered are the very foundation of technical analysis. But today, these laws are ignored, abandoned, buried under the garbage of modern trading gimmicks. And I'll be honest with you. Most traders are losing because they don't even know these laws exist. Every day, I watch people draw lines they don't understand, predict moves they can't explain, follow signals built by creators who can't even trade. They're not fighting the market. They're fighting their own ignorance. But Dow saw the market differently than any human before him. He wasn't looking at price. He was listening to it. He saw trends before charts existed. He saw accumulation without indicators. He saw distribution without patterns. He read the market like a language. Because to him, price wasn't noise. Price was truth. That's the part modern traders miss. They want shortcuts. They want tools. They want certainty. But what they actually need is the one thing they've never been taught: the foundation, the original laws, the invisible architecture beneath every chart, every breakout, every bull run, every collapse. And here's the hard reality. You cannot beat a game when you don't understand the rules. You cannot forecast the future when you don't understand the structure. You cannot win consistently when your entire system is built on surface-level knowledge. Dow didn't design a strategy. He discovered a world, a way the market breathes, moves, and reveals its intentions. A world today's traders never see because they're staring at screens instead of structure, reacting instead of reading, hoping instead of understanding. And that's why this episode matters. Because I'm not here to entertain you. I'm not here to give you another top 5 trading tricks video. I'm here to drag you back to the source, back to the roots, back to the origin of every trend line, every momentum concept, every bull and bear cycle the world trades today. I'm here to show you the truth that modern trading hides. Every successful trader, Livermore, Wyckoff, O'Neill, all of them were just expanding on what Charles Dow already discovered. You've been studying the branches. It's time to study the trunk. So listen carefully. Because once you understand these lost laws, once you see the structure Dow revealed, the market won't look random anymore. You'll start to see intention instead of noise, cycles instead of chaos, signals instead of confusion. You will finally understand why price moves. And once you know the why, the how becomes simple. And that's where we begin. A truth Charles Dow understood long before charts, long before brokers, long before you and I ever touched a market. The market is always telling the truth, but traders are always lying to themselves. That is the paradox, the inner conflict, the silent war inside every trader's mind. Dow saw it before anyone else. He realized that the market itself is simple, beautifully simple. But the human mind is catastrophically complicated. Let me tell you exactly what I mean. Every trader says they want the truth. Where is the trend going? Where is the smart money moving? Where is the next reversal forming? But the moment the truth appears in front of them, clearly, calmly, mathematically, they refuse to accept it. Why? Because the truth rarely matches what they want to believe. Dow watched this happen in real time on the ticker tape. People didn't lose because the market was unpredictable. They lost because they were fighting the tape, trying to impose their emotions on objective price movement. It's the same problem today. When price rises slowly and steadily, the truth is simple. The market is in an uptrend. But traders don't want to buy because it's already gone too far. When price breaks down cleanly, the truth is obvious. The trend has reversed. But traders don't want to sell because it will bounce. When volume confirms direction, Dow's system is screaming the message out loud. But traders don't want confirmation, they want comfort. This is the paradox. The market rewards discipline. The trader seeks excitement. The market rewards patience. The trader seeks speed. The market rewards alignment. The trader seeks prediction. Dow realized something so profound that I want you to tattoo it on your trading psychology. It's not the market that confuses you. It's your refusal to accept what price is clearly telling you. Modern traders think they're fighting algorithms. No, you're fighting yourself. Dow saw traders in 1899 do the exact same things traders do in 2025. They overestimated reversals. They underestimated real trends. They labeled normal pullbacks as disasters. They called healthy rallies overbought. They traded their beliefs, not the evidence. He understood that the inner conflict, the war between what the market shows and what the mind wants, is the reason 95% of traders never win consistently. And here is the brutal truth. Until you align your beliefs with the market's behavior instead of your hopes, you will always lose. Dow built his entire philosophy to solve this conflict, to give traders a structure stronger than their emotions. Most traders don't lose because they're wrong. They lose because they need the market to be right for them. That need, that emotional hunger, is the psychological trap Charles Dow saw more than a century ago. A trap so powerful that even intelligent traders walk into it blindly. Dow called it the illusion of early knowledge. Today, you'd call it guessing, predicting, anticipating. But it's deeper than that. It's the belief that you know something the market doesn't. The belief that your opinion deserves respect. The belief that you can see ahead of the tape instead of reading what the tape already shows. Every trader thinks they're the exception. Every trader believes their mind is sharper than the crowd. Every trader wants the thrill of being early, being right, being special. But here's the hellish truth Dow discovered. The moment you want the market to prove you right, you're already wrong. This psychological trap has 4 deadly layers. 1. The illusion of control. You see a chart pattern. You see a level. You see a candle formation. Suddenly you believe you have control over what happens next. You don't. Dow knew it. He wrote it plainly. The market owes you nothing. 2. The emotional forecast. You think something should happen. You expect it. You plan for it. But Dow said this is the death of objectivity. Because the moment you expect the market to behave in a certain way, you've already stopped reading what it is actually doing. 3. The disbelief reflex. This is where traders get slaughtered. Price moves in the opposite direction. The market contradicts your belief. The tape shows a different reality. What do traders do? They don't adjust. They don't adapt. They don't accept the truth. They fight it. Dow observed this every day on the ticker. A trader would buy, the market would fall. And instead of respecting the movement, the trader would defend his ego. Price becomes the enemy instead of the teacher. 4. The trap of attachment. This is the final nail in the coffin. You're no longer trading the chart. You're trading your hopes. You're trading your bias. You're trading your identity. Dow saw this trap destroy more traders than panic, greed, fear, or volatility combined. Because once you attach your ego to a trade, you stop seeing the trend. And that's what Dow believed was the central sin of speculation. The trend is obvious to the mind that has not already decided the outcome. This psychological trap is why most traders never break through. It's why they misread price action. It's why they hold losers. It's why they exit winners too early. It's why they trade noise instead of structure. And Dow built his entire theory as an antidote to this poison, a way to strip away delusion and force traders to see the market as it truly is. Let me take you inside Charles Dow's mind, because unless you see the market the way he saw it, you will never understand why his system still crushes modern strategies built 120 years later. Dow didn't look at the market the way traders do today. He wasn't hunting for patterns. He wasn't reacting to headlines. He wasn't guessing reversals. He wasn't drawing 100 indicators to explain one candle. Dow did something far more powerful. He removed himself from the equation. He stepped back emotionally, mentally, completely, until all that remained was price movement and logic. Where you see noise, Dow saw structure. Where you see randomness, Dow saw intention. Where you see chaos, Dow saw cycles. He believed something nobody dared to consider in his time. The market is not a crowd. It is a system with laws, patterns, behavior. A system you can read, understand, and follow. If you stop trying to outsmart it. Dow's entire perspective was built on 3 brutal principles. 1. The market moves in trends that don't break easily. He saw what others ignored. Price doesn't zigzag without meaning. When a trend begins, it has purpose. Institutional direction, collective intention, economic weight behind it. Dow didn't chase tops or bottoms because he understood something modern traders still ignore. A trend continues longer than any trader expects. He didn't try to find turning points. He waited for the market to prove them, and that patience is what made his perspective invincible. 2. Every move has 3 phases, and you're always in one of them. Dow looked deeper than price. He looked at behavior. He learned that every major market move has the same 3 cycles. Accumulation, the smart money phase. Public participation, the trend becomes obvious. Distribution, weak hands buy the top, strong hands exit quietly. This wasn't theory. He watched it live on the ticker day after day. He realized traders weren't losing because of bad entries. They were losing because they had no idea which phase they were in. Most traders still don't. 3. Price and volume tell the truth before anyone else. Dow didn't trust opinions. He didn't trust forecasts. He didn't trust rumors. He trusted confirmation. He trusted the tape. To Dow, price revealed the truth. Volume confirmed the truth. Everything else was noise. That's why he could see reversals before the public felt them. That's why he could identify real trends long before the crowd realized what was happening. His perspective was ruthless. If price and volume disagree with your opinion is wrong. This is the lens Dow viewed the market through. A lens that frees you from emotional traps and forces you into logical clarity. And now that you understand Dow's perspective, it's time to see it in action. Wall Street once witnessed a shift so subtle that almost no one recognized it except Charles Dow. The newsroom was nearly silent, lit by low lamps, while the ticker machine chattered in the background, spitting out the truth line by line. Most traders were celebrating a long, confident bull run. Stock prices had climbed for months, and the entire street believed the trend was invincible. But the tape told a different story. Price was still rising, yes, but the rise had lost its conviction. Volume began thinning out, not dramatically. Not enough for the amateurs to panic, just enough for a trained eye to notice that the market's strength was hollowing out. Dow watched another sequence of prints roll in. The highs were no longer pushing with momentum. They were weakening, fraction by fraction. For ordinary traders, these changes looked meaningless. For Dow, they were structural fractures. Then came the most critical signal of all. Industrial stocks, the public favorites, continued climbing. But rail stocks, the backbone of American commerce at the time, started slipping. Industrials up, rails down. The two averages disagreed. This wasn't a minor difference. This divergence, according to Dow's logic, was a breakdown in market harmony. When the pillars of the economy no longer moved together, the trend lost credibility. Yet the public remained euphoric. Traders bragged about easy profits. Newspapers pumped bullish confidence. Brokers encouraged more up. Everyone was blind to the structural rules tumbling.
I don't ever slow up, no, I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up and make a statement. I don't ever slow up, no, I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up and make a statement. Everything I do so instinctive, it's passionate. Every word I move so descriptive like an adjective. I got a vendetta against people who acted being negative when you should be getting after it. I got facts over tracks, this and that, spitting slow, spitting fast, I can roast, I can gas, think I'm okay at last, but I don't know if that can erase all the past and the pettiness. A reflection of the emptiness, hilarious, if you're with my time, you're delirious, mysterious, because you are not a fake exterior, inferior, you know I'll always be a bit superior, get off of me, this ain't no humble brag, I want you to hear words, you can say them back, I want you to feel free from the chains that last, and to believe in what you got, it was built to last.
And it spread to traders who had spent months believing in an endless race. Headlines blamed brokers blamed rumors. Amateurs blamed
No, I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up and make a statement. I don't ever slow up. No, I don't take shit. I got no love for the fakeness. If you wanna play
others
tough
chased the illusion of strength. This is the essence of Dow's method. Follow the evidence, not the excitement. Follow the structure, not the crowd. The moment the market cracked, everything changed. The same traders who were fearless a week earlier suddenly looked like they had seen a ghost. Screams were read, prices slipping faster than anyone expected, and all that confidence, all that loud, bullish certainty evaporated into silence. I watched the panic unfold exactly the way Charles Dow would have predicted, because the crowd always behaves the same way, blind during the build-up, hysterical during the break. The first wave of selling wasn't even the real collapse. It was just the realization, the psychological slap, that the trend was no longer obedient. The market had stopped responding to their expectations, and that's when fear began tightening its grip. Not fear of losing money, fear of losing control. Dow understood this more deeply than any trader of his era. In his writings, he warned that the public never believes a trend has ended until they're already trapped inside the reversal. They need pain to accept reality. They need loss to see the truth. And in those early days of the drop, that's exactly what happened. As prices continued weakening, the crowd tried to bargain with the market. They told themselves the dip was temporary. They searched for bullish news. They waited for some miracle rally to undo the damage. But price did not care. And this is where Dow's philosophy slices through the noise. The market doesn't reverse because traders panic. Traders panic because the market reverses. It's not emotional. It's structural. Lower highs were already in place. Volume had already flipped. Averages had already diverged. The foundation collapsed long before the public felt the quake. I could almost hear Dow's voice in the chaos. Trends end slowly and then all at once. The public only saw the all at once. They never saw the slow part because they never learned to read it. As losses accelerated, traders abandoned their earlier bravado. They dumped positions at the worst possible prices. They chased every tiny bounce, hoping for salvation. They repeated the same desperate behaviors Dow documented more than a century ago. Emotional, reactive, blind, the opposite of disciplined trend analysis. And while the crowd screamed for explanations, Dow's rules stayed brutally simple. When averages disagree, the trend is weak. When volume confirms direction, the trend is real. When price violates previous significant levels, the trend has shifted. The crowd ignored all three. That's why the collapse felt sudden. Not because it was sudden, but because they failed to recognize the signals when they were calm, clean, and obvious. This is the emotional truth most traders refuse to confront. Pain is not caused by the market. Pain is caused by ignoring the market until it becomes impossible.